All right, so we are recording tonight. Mitch and I are hosting a meetup with thoughts and techniques towards trading and investing towards retirement. Mitch is going to handle most of the load, but I have some questions that people sent me, Mitch. So for at the end, if we could do a couple minutes of Q&A would be great. And then if you want any, if you have to ask any questions, just put it in the Q&A box, and we're happy to answer them for you. But why don't we just get rolling so we get started on time, and that way the recordings, we know where everything is, Mitch. And I'm going to turn this over to Mitch, and we are ready to go. All right, Mitch, it's all yours.
All right. Good evening, folks. How are you? My name is Mitch Firestone. I've been a trader for about 11 years now. And I day trade, I trade futures, I trade equities and options. And I have to say most of my activity for the last few years is it's sort of gravitated towards equities and options. And that'll obviously tie in very nicely with what we're going to talk about tonight. So the underlying theme here is, sort of investing towards retirement. And if you notice, I also threw the word trading in there because there are certain trading principles that apply towards also going towards investing and also building towards retirement. So it's not just sort of plain vanilla buy and hold, but there are intelligent tactics that can be brought into play in order to help to kind of juice returns, but and still maintain safety. Okay. Obviously, there's always the ubiquitous disclaimer here. So, obviously, we're not financial advisors. All of this is for educational purposes only, and you can, of course, read that at your leisure. Okay, so. Like I said, we're going to talk about investing as well as trading towards retirement. In fact, let me cover that little subject right here. So investing, and you can just kind of read that, but essentially it's kind of long-term wealth creation. And the one key point, though, I do want to make about investing and sort of retirement is that the goal of sort of going towards retirement and saving for retirement and investing, it's to optimize. It's not to maximize, okay? Because obviously one can obviously put on trades where you could make, or positions where you could make more. But of course, accompanying that is also going to be elevated risk, okay? One gets paid for risk. And it's one thing to sort of elevate your risk in a pure trading account where you're not necessarily looking to that for your retirement, but more to sort of build near-term wealth. And then there's another thing where, you're actually kind of like putting things away for your retirement when you're not working. And so like I said, I'd like to characterize investing, and what we're going to talk about tonight is it's to optimize. It's not to maximize, and I hope that makes sense to everybody. Okay, so what we're going to do is we're going to talk about sort of various techniques here, and also the other thing I'm going to talk about very briefly here is fundamental versus technical analysis. And in fact, a lot of people kind of phrase it as one versus the other. And in fact, one can kind of bring both of those into play. We're not going to really talk a whole lot tonight about fundamental analysis, but I do not want to give any impression that that is something that's either poo-pooed or is not unimportant. Obviously, you want to trade good companies, particularly when it comes to your retirement. And in fact, that's the predicate for some of the screening techniques that I'll quickly show you here. In terms of building watch lists and figuring out essentially what instruments you're actually going to be using. So implicitly, there is fundamental analysis there because we're not going to basically be trading or writing options on or kind of basically, using really speculative kind of symbols. we're going to be using, kind of a lot of household names and mainstream, blue chip type of things and respected companies. And of course, the other thing that we're going to talk about here is everything we're going to do, or a lot of what we're going to do, is actually going to be on stocks that pay dividends. Because of the fact that when you can, on top of doing everything right in terms of capital appreciation and in terms of, let's say, writing covered calls, if in addition you're also obviously picking up a 2 or 2.5% dividend on a lot of things, that's obviously awesome. Years ago, I actually did some work for a company which no longer exists. Well, I guess the brand exists, Sara Lee, and they couldn't pay. At the time they didn't want to. They didn't want to actually start a project for 3 or 4 months because they didn't have money in their budget. And I kind of jokingly said to them, well, why don't you pay me in stock? And they kind of laughed. And then they called me up 2 days later and they said, you know what, if you could do that, you can start the project next week. And so they paid me like $15,000 or $20,000 for this project. And I held that stock for 10, 15 years. And it was kind of miraculous of how, and I never added a penny to the position, but how just quarter after quarter, that position just grew and grew and grew just because of the dividend reinvestment. So everything we're going to do here, or a lot of what we're going to do, is going to be key towards also having based on dividend symbols. Okay, so let me start off right here, and I want to kind of show you a really quick scan in terms of building a watch list. And of course, obviously there are very simple things one could do without even doing any sort of scanning. Obviously, you have your basic, stock lists there, and things like the Dow 30, and of course, all of those are, obviously stable, leading companies in their industries, and they all pay healthy, reliable, dividends that usually are growing over time. And so, I mean, if that was the only things that you were going to trade, and you were kind of constructing a conservative portfolio that was quasi-diversified, you could do a lot worse than picking the Dow 30. Just in terms of the dividend, I think it pays about an average of about 2.5%. So you can kind of basically do that. But obviously, I'm going to kind of show you a couple of other things here, and then similarly ETFs in terms of looking at various sectors. Various, basically the various industry sectors, and all of those are also awesome instruments to trade particularly in terms of writing covered calls, which is going to be part of what I'm going to show you here. So let me kind of start off though with the kind of the scanning element of this. So I obviously do most of what pretty much everything I do, I actually do in my platform. But the fact that since obviously people do not use the same platform, I don't want to make anything platform specific here. So I want to show you something really simple that you can use, and this is totally free. I'm sure a lot of you might be familiar with this. This is called FinViz, and it's an awesome free. There is a paid version of it. Which allows you to save, portfolios and export, however many symbols you have. So there are limitations to using it for free. I certainly use it for free, and it kind of does everything I want. And I figured I would kind of show you kind of a basic scan in terms of building a really quick watch list of symbols, or at least that'll get you, let's say, 3/4 of the way there in terms of symbols that kind of fit the scheme of what I want to show you here. So the thing that I'm using here is this scan here. So I'm starting out with mid cap stocks, okay, in terms of market cap. That's $2 billion, okay, or more, okay. Then I want all of these stocks. I want to have them all pay a dividend of at least 2%. Okay, I want to make sure that they all have options. So that basically we could either be selling covered calls when we own them, or we can basically be selling cash secured puts as we're waiting to own them. So I want to make sure that there's actually options there. And then in terms of the share prices, these are all basically stocks of $50 to $100. Okay. Now, needless to say, one can obviously jack up the share prices as much as you want. But needless to say, of course, for a lot of people, myself included, I'm not racing to be buying, four-figure stocks in terms of actually owning the shares. That chews up a lot of buying power, and it's whatever your personal situation is. So, for the moment, I have this thing set for 50 to 100. But in fact, one could, let's say if you want to set the ceiling at 200, obviously you can do that too, and of course, then you'll end up pulling in even more symbols. So this is the basic. This is just a sort of a basic scan here. And if one just runs this scan itself, and I just ran it shortly before we began this session, you come up with 166 symbols here. Okay. And then, again, these are mid-cap stocks, over 2% dividends. They all have options, and again, they're basically at $50 to $100 a share. And the reason I put a floor under it is, you're not going to basically find good stocks that are also paying 2% dividends at $30. Even $50 is kind of pushing it. But there are here and there are actually some that actually meet that criteria. So that's the basic scan. Now there's a second scan when one can add in just a little extra here and to enhance it. And so there is this one. And what this one is, I've added in the fact that, I want to make sure now that each of these companies not only meet the criteria that I described before, but they're also profitable, They're also basically have shown positive sales growth over the last 5 years in terms of their revenues. Their earnings per share has grown over the past 5 years. And the return on assets. And so this essentially kind of enhances that basic scan. And when one does that, it kind of chops it in half. And now you end up with about 78 shares, 78 symbols. But there's a whole lot of, great symbols that one can trade here in terms of starting to build these positions, in terms of paying dividends and writing covered calls. And so this is, like I said, a really nice quick scan that I kind of came up with, and I kind of wanted to share with you. And when we send out the summary of this tomorrow or Monday, I'll make sure to actually have I'll do screenshots of this so that you can basically have this in terms of being able to reproduce these scans on your own. But again, this is FinViz is totally free, and it's a great utility. So I just kind of wanted to share that. Then there's also another scan, and this is one that can't be done in that. But so I am going to go to my platform now. But this is one that I've actually, and Ryan and I have actually gotten some really great trades with, and it's something that's actually, in terms of swing trades, and it's actually relatively simple, and yet it's proven to be quite powerful. And there's actually a little story associated with it. So I'm going to spend about 30 seconds on it. Years ago, I was flipping through the charts, and I was just kind of going through it. And in the platform, there's also something you can bring up. It's referred to as a research window. And it kind of just gives you kind of a grid that kind of shows you all of the basic metrics for the company. It's profitability and return on assets and debt to asset ratios, all that kind of stuff. And one of the things that it actually showed was the ratio between price and its book value. And book value essentially is net assets minus net liabilities, and that's kind of book value. And I kind of looked at it, and they express it in book value per share, and versus and of course the share price. And what I found was, and I was looking actually at Alcoa Aluminum, AA, and I was looking at AA, and it's one of the two leading companies in the aluminum arena in the Western Hemisphere, and its price per share was less than its its book value. And I'm looking at that, I'm like, well, that's kind of weird. How could that be? And yet it was just some sort of anomaly in terms of a mismatch of sort of the market, for whatever reason, just not wanting to value this thing. And so as a result, I kind of looked at it and I looked for my tactical entry on this. And I'm like, there's something wrong here. And I made sure that the company wasn't laden with debt. There was nothing untoward going on. There was no scandal. There was no debt, in terms, nothing extraordinary. So I ended up buying it. And basically the stock doubled inside of 6 or 7 months. But basically I was led to that by by thinking about that and doing that. And so as a result, what I've actually done in my platform is, and let me just bring up the scans here. Sorry about that. Seem to have lost. All right, so what I'm going to do is I'm going to move on here. And then as soon as this thing comes up, for some reason, one of my desktops shut down here. I don't know why. So let me just bring this up here. And I'll bring this up. And then as soon as it opens up, I'll go back to that. Okay. So I'll go back to the PowerPoint here. So at any rate, so what I'm going to show you here, though, is that once that scan comes up, one can also come up with a similar scan where you're basically identifying a whole mess of companies that meet, the various criteria in terms of its market cap, in terms of, having options, but then adding in that extra element that they are basically really undervalued in terms of looking at what its book value is versus its share price. Okay, so and I basically thought about this over about 5 or 6, maybe 7 years ago, and so as a result, this has been kind of like one of the mainstays of my when looking for swing trades. And then when I'm talking about swing trades, I'm really talking about kind of anywhere from short to mid-term positions or even long-term positions. Okay, you don't really care about that if you're looking at a swing trade for a week. That doesn't really mean anything. But if you have something that's like you're going to be holding it for 4 months, 6 months, 8 months, where there's time for actually analysts to start pounding the table about looking at a particular symbol, then all of a sudden that kind of comes into play, because all of a sudden when I was owning Alcoa, 2 months later, all of a sudden it started flying for some reason. And one of the things was the analysts kind of got on board with that. So I will show you, kind of showing you that scan here. Okay. So moving on here. So one of the things that we want to do, and in fact, let me go back to that. So what we want to do is basically, once we have our watch list, what we want to do is basically kind of put all of these things into play here. So we're basically looking for tactical stock trades. And when I'm talking about trades, again, I'm not talking about day trades or short-term swing trades. I'm really talking about kind of anywhere from mid to long-term trades here. Okay. So we're, in terms of, looking at time frames, we're not looking at 5-minute charts or 15-minute charts. We're basically looking at daily and weekly charts, and occasionally a 2-hour chart, which is really just a way of refining the daily chart. But really, it's kind of daily and weekly charts. And of course, at that point, we're looking for capital appreciation. Okay. Then we're also, of course, as I said, most of the individual stocks, or a lot of them, are going to be ones that pay out a reasonable dividend, and usually a dividend that tends to grow over time. So obviously, for your long-term holdings, that previous watch list is obviously good. Then I'm going to talk to you about what I refer to as a tactical covered call. Okay, and also on terms of the ETF. in the stock trades. And notice I put the word tactical in it. And the reason that I put the word tactical in it is because when I started, before I learned to trade, I used to use a broker and a financial advisor, and he would call up and go, you should be in XYZ because I love its sector, or I like this and I like that. And of course, the answer was, okay, well, when should we do this? And of course, the answer was yesterday. Buy it now. Okay. And sure enough, of course, you buy it. And what's the first thing that it does after somebody pounds the table? Of course, what does it do? It drops. Okay. And it drops, 5%, sometimes 10%. And of course, it's really annoying. And in fact, I ended up kind of blowing up the relationship with this guy. And I was actually very embarrassed about this, but he kind of called me one day, and all of a sudden, he kind of brought that up again. Hey, you need to buy this. And I'm like, why don't we just wait 3 weeks until it drops 10%, as it usually does? And that was just so nasty and so snarky. I was really embarrassed that I did that. And it really destroyed the relationship. And I actually called him the next day and I kind of apologized. But nonetheless, that was kind of almost the beginning of the end. So the point being here is that once you determine what you want to own, you want to be tactical about it. Don't just go diving in because somebody says that something's going to be good. That's okay, but more often than not, let's wait for a pullback, or at least wait to scale into a position, and don't just sort of commit everything in terms of the position, unless the chart is really telling you that there's a real good reason to do that. So that's why I determine this as a tactical stock trade. And similarly, I'm going to talk to you about tactical covered calls. Again, it's not just simply a matter that once you own a symbol, that you just immediately write a covered call and you try to get as much as you can for it. In fact, well, you're going to see that, in fact, really what we're going to endorse is basically using the chart to essentially determine, okay, where the chart actually might create a shield to avoid having the stock called away from you. Okay, because obviously, you can buy it, far enough out of the money that, of course, it's not going to get called away from you. On the other hand, if you buy it that high, if you sell a symbol, if you sell a call that high, you're going to get no premium for it if it's too far away. So what you want to do is you want to sell it so that you have premium that's relatively close enough where you can get some reasonable premium, but far enough where basically if getting the stock called away from you is going to be a consideration, and particularly when it comes to tax considerations, then you can kind of cover both bases, where you're kind of taking in reasonable premium, but you're also kind of lowering the likelihood that the stock is going to get called away from you. Okay. And then similarly, and we'll probably do this in a future session, we're going to also talk about the use of cash secured puts in terms of actually getting paid to wait, as well as to lower the cost basis for something while you're waiting for it to actually pull back to a particular level. Okay. And in terms of the tactics of what we use, some of you already know, who already I'm familiar with, and I know, at PTL, we kind of look at things through the lens of supply and demand. Okay, and these are these areas, and I'll kind of show you a couple of charts that illustrate that. But they were basically these areas of price imbalance where previous history suggests that there's going to be either upward price pressure at levels that are below current price, or downward price pressure at levels above current price. And so, basically in terms of investing, we're more or less, looking to basically be buyers pretty much. So we're looking for these areas of what are referred to as demand. And I'll kind of show you that. And then there's also concepts of relative strength. And I'll kind of show you briefly, I'll kind of show you that as well. Okay, so that's kind of the overview of. So let me kind of go to the charts here, and I'll kind of start to show you some of the things that we can do. Okay. So, so let me show you what one of the principles here of kind of how we look at charts, and then I'll kind of obviously then show you how it ties in with this whole concept of sort of buying these dividend stocks in order to enhance retirement and also set the stage for selling covered calls, but also getting in at the right time. Okay, so here was something that I had put up for our subscribers recently, and we had actually done. This was actually a seminar that we had done for them, and it was a little lesson that we were doing about position sizing. Okay, and so this was done. What was it? About 2 weeks or so ago, on the 13th of August, and we were looking at this, and basically this was I looked at and sort of saw in a daily chart it was something sloppy over here, and I kind of then broke it down to a 2-hour chart, and this was basically kind of exposed that there was kind of this level on top of another level here. Okay, and basically what the story of this level is that price came up here, it kind of consolidated briefly in these two candles here, and then it kind of rocketed out of there. In terms of this bullish candle, there was a little pause. Then, of course, there was this major gap and this very bullish candle. And so you had price kind of rocketed out of there between all of that. Okay, so this is an area where we had basically supply and demand for shares that kind of went sideways here. And then all of a sudden right here, the sellers just disappeared. And in order for these trades to all have occurred, what happened was the buyers ran up the price chart until they encountered willing sellers. Okay, so that's essentially the story of this level here. So price comes up, consolidates briefly, kind of we have a very bullish move out, a little pause, and then this massive gap and this very bullish candle, and then it continues to kind of shoot up from there. Okay, and so the expectation is when price and then what the way our trades are set up is that we're waiting for price to return to this level. Because there's the expectation that not everybody that wanted to buy at this level got the opportunity to do so. Basically, price was sitting in here for really a day, and then it kind of just left suddenly. And so as a result, some traders kind of ran up the price chart because there was the fear of missing out, FOMO. But then a whole bunch of people, including me and Ryan, we were like, well, price left the building here, and we're certainly not going to buy it. So what we were doing is when we were looking at this right here, and this is when I brought up the chart on the, I guess that was the 12th to the 13th. Okay, when I was looking at this chart here, I was like, oh, okay, well, that's a kind of a nice looking level down here. And so if we get this pullback from here, okay, there's the expectation that we would get a bounce out of either here or perhaps even lower, although I was really not thrilled with this level down here for a particular reason. I'm not going to go into it now, except to say that I don't like the fact that there was this trading sitting to the left of it. Okay, but really, this was the level that I kind of really liked here. And so the expectation was when price returned to this region here, we would end up getting a bounce. Okay, and so this is what I was kind of explaining to our subscribers. Okay, so this is what we're looking for here is a tactical entry into buying this particular symbol. So, it's not like some people may go, okay, well, this thing was sitting at a high. This thing was sitting at, 123 or something at its all-time high. It's now dropped to about 116. You know what? Maybe I should just buy it here. And the answer is no. I was not going to buy it here. I was going to buy it down here. And if it didn't, make it all the way down there, then I just wouldn't buy it. Or, I would wait for some other level at some point in the future to form. But there was no reason for me to buy this unless I got my price here. Okay, so that's the underlying setup for this particular symbol. So if we go back to this now and just find that chart. So there we go. So there was that right there with the dotted line here. This is where I was looking at. And I did all the analysis, and this is the chart that you saw before, okay? And you can see price came down, drilled into this zone, okay? And then we got the bounce here, okay? And so this is where the tactics come in. So that if, let's just say we were looking at this as a particular dividend stock, okay? We would basically be saying, okay, look, we want to buy this. but in fact, we're going to wait for price to pull back to this region, and then this is where we're actually going to buy it. Okay. And then at the time when I kind of set this up, I also said, okay, this was kind of a reasonable, what I thought to be perhaps if this was just going to be a single trade and one where there wasn't going to be a hold, this would represent a reasonable target. Why? Because essentially it's almost the opposite story of here, where price came down, kind of sort of went sideways, and then we sort of had a little bearish move, and then price came back here again. But the expectation was this would represent a kind of a reasonable target. And so we ended up getting a bounce there, and basically kind of went back there. And this is kind of what we're looking at now. So basically, it kind of got stopped by this level. Okay, but again, if one wanted to sort of build a position here, one could obviously then have, using that technique, we wait for kind of a pullback to these areas of demand where the expectation is that there is still what I would refer to as latent upward price pressure. In other words, this price pressure that's still sitting in here is just waiting to be tapped. And the reason it's waiting to be tapped is because when price consolidated here, price was there very briefly. Okay, it wasn't there, for days or weeks. If this area consolidation went across like this, then this wouldn't have been interesting. Why? Because perhaps everybody that actually wanted to buy at this level would have had the opportunity to do so. But since this thing was really in here, almost for a matter of hours, it was really almost like 2/3 of a day, because once price came up and it kind of went sideways, and then this is the next day. So this is really like 4 hours of activity. It's not even a full day. So the expectation was when price came back here, that's why there was some reasonable confidence that we would kind of get a bounce. I don't necessarily know it was going to bounce that much, but or that quickly. But sometimes sometimes a plan actually comes together, and it actually does what you expect it to do. Okay, so that is the concept of a tactical entry. And tactical entries could be used either for trade, just sort of one-off trading, but could also be brought into play for building positions for investment, and again for trading towards retirement. Okay, let me show you another example, and then this will actually start to tie in now with the concept of talking about covered calls here. Let's see here. What symbol I was trying to look at? WFC. Okay. So here's Wells Fargo. Okay. So obviously a major bank, and let's blow this up a bit. Okay. So again, this might, to some small degree, remind you of the other chart for the Intercontinental Exchange, ICE. Okay, but once again, we had price comes up here, kind of we had this little sideways jog here. Okay, and then basically, basically consolidated here. We had this little pause here, and then again a very bullish candle here, and then basically kind of pause, a bullish candle, pause. In fact, it was really kind of very rhythmic. On the next few days, in the first third of the day, it kind of shot up, consolidated, shot up, consolidated, and then it just kind of marched from there. Okay. So again, the concept was waiting for price to pull back to this region in order to then have our entry to basically get in here. Now, at the time, this was not built in terms of necessarily being a long-term investment vehicle, but this was actually built to be, it was an option setup that we share with our subscribers here. And so at this point, we said, okay, we were going to basically express this trade. Either you could buy stock with this, or of course you could actually buy a call. Okay, so this was the call that we suggested buying. This was the projected premium over basically projecting a range out for the next few days, and also mentioning the fact that the earnings announcement was not going to really be affecting this because it wasn't going to come up for a while. Okay, but anyway, that's the underlying thesis here, is that we're looking for a tactical entry in order to get into this, in order to either create a trade or to actually start building a position. Okay, so if we go back now to the charts, so that was the before picture. So if we go back here now, here's the after. Okay, so again, price came up, we went sideways. We had this explosive move. Again, price kind of shot out of there, kind of made its way up, and then this is where we basically were looking at it around here. And so when price came back here, that's where we got our entry here. So we ended up buying some options here, and it all worked out really nice. Now, the reason that I'm now showing you this, again, this is another example of the tactical entry, but now we get into the concept of a tactical covered call. Because again, one of the things that we want to do with the covered call is we want to sell premium. B, we really don't want to sell the premium too far out with respect to too much time. Okay, because obviously time, as they say, time is money. And of course, the more time you sell, certainly the more premium you're going to collect. But the other problem is time is also time for things to go wrong. Okay, and so if you sell a covered call here, and if let's say you sell a covered call at around, let's say 49 or 50, and you sell it like 30 or 45 days out, you're really just looking for, you're looking for trouble here. Okay, so as a result, what we are generally fans of here is really selling covered calls, but selling them really of relatively short time duration. More often than not, 2 weeks seems to be a really nice sweet spot. And the way we do that is, in a sense, we're not collecting huge amounts, but we're collecting 50 or 70 cents, let's say, per contract. Depends on what symbol you're trading and what its circumstances are. But the thing is, because of the fact that it's basically only it's only a 2 week trade. Of course, the time decay on that is extremely rapid. Okay, you're selling it out of the money. In this case, let's say if we sold, let's say the 50 or the 49. This was, I think we sold the 50 on. I would have sold the 50 on this based on. Okay, and basically the reason I would say I would sell the 50 here is because I was going to rely on this level here and this level to essentially represent, which would essentially represent shields to really stop price from kind of going much further, at least in the short term, in terms of, let's say, the 2 weeks that I'm in the trade. Okay, and so right here, while this was an area of demand here, okay, what we have here is what's referred to as an area of supply. And what happened is price came down, price consolidated. Then we had a little shot down on this kind of very, bearish candle. And then we had another bearish candle here. So I wouldn't necessarily think about shorting out of this level. But to me, looking at this level and this level, these are sort of regions in the chart that represent what I would refer to as potential speed bumps if price starts to rise. And what these speed bumps do is, in terms of a covered call, is two things. They literally slow price down, and so you benefit from time decay. And then the other thing is these levels also represent what we might refer to as shields. So that if you sold, let's say, the 50 call that was 2 weeks out, whenever 2 weeks out was, okay, well, then basically you were about $3 out of the money, okay? But at that point, then you had this thing that was going to basically slow price down. And then this thing, if it actually got to this level, the presumption would be, even if this didn't turn into a great short, it would at least kind of stop it and might actually send it down to at least a small degree. And of course, as we know, if we sold the 50 call, what we needed to do, of course, is to expire worthless, or within the 2 weeks. And it doesn't make a difference if it goes to if it's at $49.99 or $44.99, as long as it's not above 50. We've done our work is done and mission accomplished. Okay, so having two levels in between. So if one level up here to stop it at the very end is cool, well, then having a level over here to stop it on its way up is even better. And so that's what, and then we can see when price actually came up here, we ended up with that, you can see right now, price is kind of stalled up here, at least for the moment. And so if we happen to have been in a covered call situation here, well, then all of this is what's happening here is that the value of the call is obviously diminishing here because of the fact that time decay is just leaking, the time value is just leaking out of it. And that's really a direct consequence of this level here. Okay, so that's what I'm talking about here when I refer to as a tactical covered call as opposed to just a covered call. Okay, because a lot of people, what they're going to do is they're going to look at this and they're going to go, okay, well, this is good. I got in here. This thing is starting to move. Let me sell a covered call. And, some people may even go, you know what? I got to get at least $1. Okay, I got to get at least $1 a contract or it's not worth my while. Well, the only way you're going to get $1 per contract is one of two things. Either you're going to sell a whole lot of time or you're going to basically be selling this thing much further down, okay, so that you're much less out of the money than what we are, than what I was here, okay, or what we would have been here, okay. So in this particular case, we'd be $3 out of the money, let's say selling the 50 versus about 47, okay. The only way you're getting $1 here in terms of would be, again, you either have to sell a lot more time or again, you're going to be selling this thing, let's say at a much lower strike, and then you're just asking for trouble here, right? Because if at that point, if let's say you sell the 48, well, then, you can see this thing just, drilled right through that. And that's frankly expected. And so as a result, and that's okay if you're okay with either getting the stock called away from you. But if you don't, and you really want to sort of just make extra money on these positions, then more often than not, you really don't, particularly if you're trading a cash account, obviously you don't want to be get the stock called away from you just for tax considerations, or you just don't want, essentially, again, you don't want to have to go through the issue of getting the stock called away. And even if you're in a retirement account, getting the stock called away and then having to buy it back again. And then, again, most people, they're more than happy to, basically have to take in a bit. And the thing is, if you do this, and let's say you do this every 2 weeks, okay, if you're selling, premium out every 2 weeks, well, in theory, obviously you could be doing this 26 times a year, right? Okay, 52 weeks and 2 weeks, divide by 2. So you could be doing this, let's say 26 times. Let's just say you do it 20 times and you write 16 or 17 times out of it. And let's say you pick up 50 or 60 cents a premium. Okay. Well, if you do that, let's say 15 times and you're right. Okay. Then you're going to be picking up roughly about $900 for the times that you're right. And let's say you're wrong 3 or 4 times and you end up having to buy it back for $1. So you end up losing 50 cents. Well, then in fact, then you might end up netting out, let's say $700 rather than $900. Okay, so you made $900 on the trades on the covered calls that worked. You lost a couple of hundred if because of the fact that you wanted to buy them back because you didn't want to necessarily get the shares called away from you. And so as a result, over the course of the year for selling that one contract, you made $700. Now, needless to say, it doesn't sound like a whole lot. Okay, but if you think about it, if you're, let's say, picking up 0.25% or something. Let's say you pick up an extra 0.25% every month on your portfolio in terms of, let's say trading towards your retirement. Well, if you pick up 0.25% and you do that every month for 12 months, that's an extra 3% of net return. Okay, if you're getting 8% on your money in terms of, in terms of your general portfolio, or even if you're getting 10%, if you can pick up an extra 3%, by doing these tactical covered calls, you've obviously increased your ROR on that portfolio by 30%, going from 10 to 13. And of course, it's even more significant if let's say you're only getting, let's say 8%, and you go from 8 to 11. Okay, now that's about a 36% increase just by doing these tactical covered calls. Okay, so what we want to do is when we sell these covered calls, is we want to understand taking advantage of time decay, which is actually really taking in less money by selling a much shorter duration than you might sort of think you might be happy with. but really selling a short duration, taking in, let's say, anywhere from 40 to 75 cents, depending on what, the volatility of what the instrument that you're using is. Okay. And then also looking to the chart in order to then look for shields in terms of creating speed bumps and creating actual, let's say, shields that will actually stop price from getting back to the getting to your strike. Okay. And in fact, one of the things that we'll do is when you want to construct your covered calls is, in fact, maybe even reject certain ones because of the fact that even though you can take in some reasonable premium in a reasonable amount of time, and let's say only selling for 2 weeks, on the other hand, you may look at it and go, well, there's really nothing to get in the way of price if it has already started on its way up. And so as a result, here and there, I'll kind of reject something if there's nothing that'll actually kind of get in the way of price. So that's all involved in the tactical element. And then the last comment about this is also, remember, the environment that we are in now could very well change shortly. Again, we're sitting at all-time highs here. We're now kind of, price is kind of channeling. But this is oftentimes the situation where you might actually end up getting a little thump in the market. In a sense, it's been quite a while since we've seen not even a correction. A full-blown correction is obviously considered to be 10%. We haven't even seen a 5% pullback in the middle of a pandemic for quite some time. It's probably due to happen. And the thing is, once that happens, options are going to become more expensive. And that'll, of course, be reflected in the concept of implied volatility. And so as a result, when implied volatility goes up, all of a sudden the options where you would be selling a covered call and you might only take it in 40 or 50 cents, all of a sudden now you might be taking in 70 or 75 cents if IV increases. So always remember that all of these trades are in context and are also tied to, of course, the trading environment in which we're functioning. Okay, so that's that's sort of the intro to what I would refer to as tactical covered calls. There's obviously a lot more to it, and in fact, we'll certainly be doing some sessions in the future where we'll actually start to kind of build these. But I kind of wanted to introduce the concept. And again, in a sense, what we're doing is when we do these trades is we're trading for value and not simply trying to get as much as we can. Because again, trying to get as much as you can, you either have to sell too much time or you have to sell with a strike price that's basically too close for comfort. And so as a result, if you kind of lower your expectations and also trade to a goal, which is to basically kind of, juice your returns. And if you say to yourself, okay, well, listen, I'd like to kind of jack up my returns by, let's say, 3% a year from 8 to 11. This is a really sweet way of doing it. And it's really, relatively, basically low risk. And, and of course, the devil's in the details. But once one learns the simple concepts associated with this, one can really do this and kind of, on a rinse and repeat basis, and particularly for things that you already have in your portfolio. So at this point, imagine that you're holding this or you're holding something else that's, let's say, paying a 2% dividend. So you're getting the dividend reinvestment, and then you're picking up an extra, let's say, 2.5% or 3% on an annual basis, writing calls. So in addition to hopefully your capital appreciation on the shares, you're basically picking up an extra 5 to 5.5% between intelligently picking some dividend stocks as well as then again doing these tactical covered calls. Okay. So that's what kind of all. So we're basically talking about doing intelligent entries based on the price action. I kind of talked about just that concept of supply and demand earlier. And then, and again, we talked about the tactical covered call. And then, like I said, in a future session, we can actually talk about doing what are referred to as cash secured puts. And that really more or less involves, at least the way we kind of go about it, is looking for an area where we have, let's say, one of those demand zones. So in other words, let's say right here, if I was looking at Wells Fargo here, probably selling a put somewhere in this territory, because this is the area that I'm willing to buy. In other words, I was interested in buying here. Okay. And so as a result, while we're waiting for, let's say, price to get down here, you could probably sell sell a put somewhere around here, and wait for it to kind of get there, sell it on a short-term basis, pick up a few extra cents here. And again, what you can do is get paid to wait. Okay. And we'll kind of go into that in greater detail in a future session. Okay. And so over time, what one can do is, and this is kind of like an entire menu of various kind of things that one can kind of utilize essentially the same technique, looking for a tactical entry, based on whether it's supply or demand, or using, let's say, support and resistance, or measured retracements like Fibonacci's or pivot points, or whatever your taste might be in terms of looking for a pullback. Okay, basically, so in other words, have a tactical element to your entry. Okay, and then these are all kinds of various things that one can do in terms of sort of diversifying your portfolio. But again, all of these things, particularly whether they're using stocks or using ETFs, again, as long as they have relatively liquid calls, you can be writing calls on everything that you own. Here and there, you'll find that, in fact, going back to looking at, I think it was ICE before. Okay, this is the options platform here, and this shows all of the expiration dates. One of the things, though, when you do want to write these covered calls, is you want to have calls that give you enough flexibility in terms of what your date, how much time you're selling in days till expiration. So if you notice here, these are pretty much only offer monthlies here, 21 days, 48, 84. So as a result, this was something that, if in fact I was building a position to buy ICE, though, I would actually not be thrilled about either selling calls or even using cash secured puts here, because of the fact that I'm there's no flexibility here. Okay. On the other hand, I believe, let's say if I was looking at Wells Fargo, okay, Wells Fargo, you can see here a lot of flexibility here. Okay, so we got, tomorrow, of course, is expiration date. That's strange. Why is that showing zero days? Well, yeah, I guess they're already considering it Friday. Hey, if that's the case, then I don't have to go to work, because this thing is already telling me that this was Friday. So anyway, but this, you can see that there are weeklies on all these, 7 days, 14, 21, 28, et cetera. So as a result, this would be something which would be a good candidate, assuming that you had a price action thesis on WFC, and you had those areas above that were going to act as shields or speed bumps. You could then look to these particular expiration dates, and these would in fact offer, this would be a good candidate to actually do that. So again, when you're going to do these tactical covered calls, what you want to do is make sure that you have the flexibility in there in terms of what how much time you're going to be selling. Because again, if you only have monthlies, then obviously it's much too coarse, because it's either going to be selling, and I believe on the other one it was either 21 days or 48 days and nothing in between. So that's not good. So that's the one thing is, so, but generally for most, at least for 3/4 of the symbols, if not more, you do have those weeklies that kind of give you that flexibility in order to do that. Okay, so in terms of looking at this again, one can be basically doing these. If you're actually building positions, one could use ETFs, and of course, one can basically be using all of these particular instruments in terms of owning things, and of course selling covered calls on them. The one, and of course, the one caveat on covered calls is you got to be owning at least 100 shares of whatever it is you're talking about. Okay, because again, you basically you don't want to be sitting naked in terms of the calls that you sell. You want them to be covered. It's either you're selling covered calls, or if you don't own any stock, obviously you could be doing credit spreads. But one way or another, you don't want to be uncovered, because of course at that point then you're running unlimited risk on whatever portion of the position that you're doing that. So by definition, you have to own at least 100 shares or whatever it is, and you're only going to be essentially selling calls in terms of multiples of 100, the lowest multiple of 100 shares that you own. Okay. So at any rate, that is sort of the introduction to kind of what we wanted to kind of present today. And like I said, we're going to be kind of running we're going to be doing some more sessions after this about this. And then we're actually kind of going to be getting into actually pulling some symbols and actually building positions and actually starting to then, kind of actually go through the process. So this was kind of the view from the view from 30,000 feet, but also to kind of show you what the basic ideas of the techniques are, and also to show you that the techniques that are used really could be utilized for a whole host of instruments, whether you're dealing with you're dealing with stocks, you're dealing with particular ETFs. If you want to be owning gold, you can be doing that with this. In terms of owning the GLD. So again, that whole concept of a tactical entry on the stock, and then the tactical covered call. Again, when we talk about next time about cash secured puts, there's that. And then, of course, again, what we would like to do is, as much as possible, focus in on symbols that are actually paying out a dividend, so that you can also then benefit from that. Okay. So at any rate, that's kind of the initial overview here. So Ryan, you said you maybe have some questions here, or what do we want to do here?
Sure. Let me ask you the questions that got sent to me directly. They're both kind of this very similar question. One being, should you buy a stock just to sell a covered call on it? And I saw this a couple of times, different places.
Absolutely not. Yeah. And the reason for that is, it's interesting because a lot of people think, well, I don't. In a sense, they go, well, I have downside protection on owning a particular stock or an ETF. Well, it's not giving you that much protection. Okay, so let's just say let's just say you own a stock that's $100. Well, even if you collect $1.50 in terms of, let's say, some premium, and the stock gets whacked down to 90, well, then all right, you're not down $10, but you're down $8.50. So the point being is that you don't necessarily just automatically. Now, there are certain core holdings that you're going to certainly have. Like for instance, if you're in a portfolio and you have a long-term position, and you want to diversify, you're probably going to own some SPY, you're probably going to own some Qs, maybe you'll own some IWN, the Russell 2000, TLT, which are the 20-year midterm bonds. Maybe you own a little GLD, which is gold. Maybe you own some oil, USO. So there are certain positions where, in a sense, if it's an investment, you may just kind of ride out some market volatility and some downside, and then at that point, anything that you own that you can, in other words, anything that you own, it's awesome and great if you can write a covered call on it, as long as you do it right. But on the flip side, I wouldn't just automatically buy something because I can write a covered call on. You really want to buy something that has a good fundamental, a good price action thesis in terms of the chart. So that to say, look, at least in the short to midterm, this thing is going to probably bounce and go up. It's not just going to automatically get crushed. Because and if let's say it is in danger of getting crushed, you're going to get some warning about it. Let's say it has at least a short-term bounce. Okay. Because you don't want to just buy something because somebody says, "Oh, this is, buy this, it's great." We're back to me in my when I was inadvertently nasty to that financial advisor or broker. Having just the automatic 10% sell off the second I buy it. So no, you don't want to just automatic. You want to, anything that you own, definitely write a covered call on it if it's a long-term holding and you know that you don't want to get rid of it. But I wouldn't flip it on its head and go, you know what, that I'm going to buy something in order to sell the call. Have a good reason to buy it in the first place, and then consider the covered call kind of a bonus, kind of the icing on the cake, as it were.
Great. The next one was, is there a minimum you should sell? I don't know if this would be for puts or calls. I think I know the answer, but I'm going to ask you, is there a minimum premium you should strive for when selling? I think selling puts or calls.
In a sense, yes, because of the fact that, unlike selling, unlike equities, okay, which of course is the direct instrument, you can kind of see what the bid-ask spread is on an equity trade. And in fact, you could put in, let's just say right here, okay, the limit order goes in at 46.90. So really you're going to pay 46.90. You're not going to end up paying 47.10 for this if you have a limit order here at 46.90. Options are a little different because of the fact that it's a derivative, and oftentimes that the bid-ask spread will kind of vary. Of course, if you're trading things like Apple and the SPY, Apple and the SPY and the Qs, they have minimal bid-ask spreads. And so, those particular stocks and ETFs, you can sort of get away with, not worry. But the things that you do worry about are the ones that either have higher bid-ask spreads. And the other thing is, you don't really know what you're going to be paying, right? In other words, the price was going to come down here. And in fact, when I was going to do this trade, okay, I had put this up at the time. I said the projected premium was going to be at 46.90. Okay, and I showed you the before picture, so I'm not going to bring it up here again. But this was all in the before picture before. The projected premium was going to be 370 to 420 at 46.90 for the next few days. I even throw in a question mark just to let people know, hey, I really don't know. But the point is, looking at the options platform, I can see what the projected price was going to be at 46.90 at that moment. And then I kind of have a little formula that I use to sort of build this range. Okay, and it takes into account a little time decay, perhaps a little increase in implied volatility, and that's sort of how I come up with this range here. Okay, but I really don't know what we're going to pay for this until it actually pulls back to the level. Okay, and so as a result, because you have that uncertainty, you really want to make sure that you at least get a reasonable amount to sort of make it worth your while. And so generally, 50 cents is kind of the minimum that I generally want to see, really almost for any credit, what's a credit trade whatsoever, whether it's a vertical spread, a vertical credit spread. So if let's say I wasn't going to be buying the shares, but I was just going to do a bull put spread here because I had the bullish thesis that when price came here, if I was just going to sell that spread, I would want to be taking in at least 50 cents and probably even a little more. Okay. But the fact that we're building this more for a position and also something where we could actually do this more often, like I said, kind of rinse and repeat either every 2 weeks or every month or whatever, one can sort of, basically be on the very low side of that. But generally you want to get 50 cents. But more often than not, I would certainly like to get, 75 cents or whatever. But again, I'm more charitable about getting less when I know that either it's going to be a one-off trade or it's a trade that I may be holding, it may be a short-term hold and I may get one covered call out of it, but I'm not going to really be doing this multiple times. And so at that point, I want to make sure I'm getting at least 50 cents. Once I'm in a position, if it turns out, it's going to be 40, it might turn out to be 40 or 45, I'll kind of hold my nose and kind of take it. Just why? Because it's better than nothing. Again, if it's, since I own the SPY and I own some IWM and I own TLT, I'm just writing the best covered call that I can in terms of, short term, in order for me to basically reliably sort of collect anywhere from that 1/4 to 1/3 of extra percent a month. So that, again, at the end of the year, I tacked on, let's say, 3% or so onto my net return. So anyway, circling back, because of the uncertainty about the bid-ask spread, the uncertainty of what you're actually going to be paying for the option, and you can see here, right here, what was it? So I ended up paying $385. So that was actually sitting at near the bottom of this range, and that was only because this only happened about 2 or 3 days later. So as a result, that's how I wasn't too far off in terms of the estimate here. If this went on a lot longer, obviously, this estimate either would have been garbage, or I would have actually gone back and updated it with the passage of time. But since only a short amount of time, I think only 2 or 3 days passed, it was obviously relatively easy to get to be within that range. Again, so there's the uncertainty about what the option is actually going to be valued when it gets there. And then there's also the bid-ask spread. So again, 50 cents.
Cool. All right, I think that's it for questions, Mitch. I think it's a good time to wrap up, and we'll continue on in this series, and we'll have more of these. And in the meantime, if you're watching the replay, I'll put our calendar links in the email. And if you want to have a little bit more of an in-depth discussion, you can schedule a time with us, and send us any other questions if you're watching this replay. But feedback's good, Mitch. So I think we hit a lot of the good points.
All right, and then the only comment I'll make is also, we'll send out a copy of the, we'll provide you guys with a copy of the PDF, and also in the PDF, I will also include screenshots of the screens that I showed you in the very beginning. This way, you'll have those as well. This way, you don't have to do your own screenshots. All right. So anyway, thank you all for your attention. I hope you found it interesting and helpful, and I will see you next time.
All right, great. Thanks for being with us, guys. Have a good one. Mitch, I'll talk to you soon.
Okay.
All right, bye, guys.